Hi there, Etoro. It is Monday, but instead of doing a review of what happened in the market last week, I wanted to try something a little bit different. Now, going through the comments on my Etoro feed last week, it became apparent that a lot of people wanted to know why I thought the market was irrational, or what I meant when I said the market was irrational, or they just thought that I was wrong about the market being irrational. So today, I'm going to take an example of what I am looking at and what I mean when I say that. All right, let's take a look. So I'm just going to give a little bit of context. I won't go on about this too much. I might do another video about it though. So all businesses have a life cycle. Most companies die. In fact, I can't remember the exact statistic, but I think less than 10% of the companies that were in the S&P 500 in 1950 are still there today. I think the percentage might even be lower than that. And companies tend to go through this kind of life cycle of these phases, and the time can be very long. I mean, for example, we still know that Google is growing. So it's somewhere probably in this kind of region between growth and maturity, and it continues to go. So, and that's 2 decades down the line. So it can take some time. All right, that being said, I like to invest in companies in this part of the curve, maybe towards the early part of the shakeout. I assign companies in different phases of the business life cycle, different portions of my total portfolio, because they tend to be more risky the closer they are to the left. I try to steer clear of the companies on the far left. So just to walk through this very quickly, when a company starts out, they create a product or service, and they're trying to find something that people will pay money for, right? And through launch, if they are successful, they find that thing, and then they begin to tweak it. So this line represents the sales, the revenue that the company is generating. They found their product market fit, and then they ramp it up. They scale up in all the different ways that you scale up, taking as much market share as they can as quickly as they possibly can. At the same time, the company is typically not profitable in the beginning. They're pouring money into trying to find this market fit. So you'll find angel investors, venture capitalists investing usually in this kind of phase. So pre-profit, before a company is making a profit. There are some public companies too that are kind of in this area. And as they continue to grow their sales, they become better at turning their profit into cash flow. And that's why you're seeing these overlapping curves here. And then eventually the company stops growing. You know, it finds all the market that it's ever going to be able to address. And it just tries to maintain the status quo until it can't anymore. Maybe there are more nimble competitors, or whatever they're making is no longer needed. So for example, typewriters aren't even made anymore. And so the company begins to decline. Companies start paying out dividends somewhere in this kind of area. So this usually tells you, not always, but it usually tells you where a company is at in terms of the business life cycle. Now, if we look at companies like Alphabet, unfortunately, this curve is very smooth because I think this is the annual returns. So their revenue has been ramping quite nicely the entire time, particularly recently, although I think that this chart is skewed because there was demand pulled forward through the lockdowns. And I think some of that's permanent, but it is what it is. So revenue growth has been fantastic in recent years, but it looks like it might be slowing, but who knows? And that kind of makes sense, right? There's only so many ads that Google will be able to sell. Maybe they don't top out in the next 5 years, but 20 years from now, unless they find new products, I think they will have, there won't be any new market available for them. And earnings have topped out, or they appear to have topped out, but again, I think this might be because of coronavirus. And we see similar kind of things for Microsoft, so kind of flat ramped up recently for earnings in terms of revenue. So if you look, and let's do Apple, why not? So they were flat. They found some new ways to generate additional profit, and that meant the chart took off a little bit again. So this chart usually isn't as smooth as it looks here. There are definitely some little bumps along the way as companies, because companies need to invest in themselves, and sometimes they don't see the benefits of those investments for a long time, or there are recessions, or all kinds of things can happen. So that kind of gives you a little bit of context into the business life cycle and the types of companies that I'm looking to invest in. So these 3 big companies are probably somewhere in this kind of phase of their life cycle. The company that I wanted to use as an example today in terms of why I think the market is irrational There's a company called Digital Turbine. Now, I've spoken about this company before, but this is one of my strongest conviction companies out there at the moment. And I also believe it's a really good example of how extreme the market has become irrational in certain areas. It's kind of tricky to convey the breadth of what Digital Turbine does unless you're involved in the industry, but in summary, they are a software platform that exists on mobile devices that makes it easy for advertisers, publishers to put high quality adverts out onto these devices, measure the impact of them, and then generate actual cash from that process, as well as getting end consumers to take particular actions, so usually installing an application. Now, Digital Turbine is not a new company. They've been around for about 2 decades. For a long time, they had a bit of trouble finding whatever was necessary to really take off in terms of growth. I think the primary reason for this was that they had a single application that didn't have recurring revenue. So you bought it once and that was it, and they got no more money out of it. And in recent years, they've changed this approach organically by expanding their feature set, but also by buying other companies. So they are the largest independent growth and monetization platform. Now, independent here is in inverted commas, because the other fat cats in the arena are Google and Facebook. And the moat that this company has, the thing that makes it so special, is that through its acquisitions and building our capabilities, it provides a number of different pieces to the advertising puzzle that people need when they want to deliver ads onto mobile platforms. So you can see that they have been very successful already. I mean, they're on 600 million devices, 1.5 billion monthly reach across those devices. They've got lots of partners. I mean, you can read all the numbers yourself here. I did also want to show some of their partners. So you can see that they've got a lot of major carriers as their partners. And the agreement that they have with these partners is particularly interesting, right? So if you were to buy a Samsung phone, the Digital Turbine bundle of applications is already inside the operating system on those devices. I don't know if that's all devices, but it's definitely some portion of Samsung devices. That's one of the agreements that they have in place. And the same thing can be said from, if you buy phones from any of these phone makers or telephony providers. That already is one major leg up. The platform is there on the phone, ready for others to use when they need to. The other part of the puzzle, so you can see that there are 2 major customer groups here, are the operators and OEMs, which I just showed, and then there's the advertisers and publishers. So if you are a company like McDonald's and you're trying to push out some kind of promotion, maybe you've got a new application that you want people to install, then you would typically go to an ad agency. That ad agency would create all the creative bits and pieces for you, all the pictures, the pretty pictures, and the story that goes along with it, and all the videos. They would then need to either use their own capabilities directly or outsource it to someone else that could turn those assets into something that could be pushed out on the various ad networks. There are exchanges where people bid for the different parts of real estate that you see on screen, either on a phone or on a screen. And then some portion of the screen is purchased and the ads are served in that particular area. It is quite a big ecosystem. I had a picture of it up here. So this is the ad tech landscape as of this year. So each of these rectangles, they represent one area of the ad tech landscape, and then there are obviously all the companies that operate within that area. So if you are McDonald's, like I said, and you're trying to do what I just mentioned, then you probably need to engage several different parties from each of these rectangles, which is an absolute nightmare, right? You don't have the specialist knowledge to know the full landscape and who operates in it and who are the best people and how they integrate with each other and what the costs are going to be. It just becomes an enormous nightmare in dealing with it. And so these companies have popped up because the opportunity is there. This signals to me that the ad tech kind of area is still in its infancy. What happens eventually is that these companies start being successful, and then someone steps in, or several someone step in, and they start buying up these companies and then wiring them all together and then packaging them as one big deal. And that's what Digital Turbine has done. And so far, it's one of the few companies that provides these end-to-end capabilities. Another thing that signals the maturity of Digital Turbine is that they've started to verticalize their solutions. Verticalize means that they have pre-packaged options for particular industries. Companies within certain industries tend to operate in very similar ways. And so once you've got a few examples of operating in that way, then you have a template of an approach to dealing with those kinds of companies. So this tells you that this is a business that's very mature, and having these kinds of case studies also means, because they've been successful in the past, it becomes a lot easier to acquire new customers within each of those industries. Right, I wanted to talk very quickly through this presentation. It's from May 2021, but it's the last one that they made that's quite flashy. It also talks about a lot of their recent strategies. So I wanted to walk through this quickly, and then I'll give you a little bit of an update in terms of their numbers. All right, so back in May 2021, the company was looking at $1 billion in revenue. So they're still quite a small company compared to the mega caps that are household names. The other numbers I already touched on. You can see that from Q4 2017 through to Q4 2020, they had fantastic growth, right? Their revenue grew 4 times from 10 million to 40 million, and then it absolutely took off. And in part, this was because of the acquisitions that they had made through the year before that and being able to integrate them to the rest of their suite. But also in part, it's because of the demand pull forward that lots of companies experienced through the lockdowns. We can see a similar story for EBITDA. So I guess the long and short of it is here that the company was growing very fast. Acquisitions accelerated growth, pandemic accelerated growth. This is a company that made acquisitions that cost them a decent amount of money, but the results are speaking for themselves here. So not only have they been able to integrate those businesses successfully, they've in a very short amount of time been able to turn on the money printer from these acquisitions. And that's very hard. Most mergers and acquisitions fail. What I also like to see is I like to buy good companies in growing markets. And so here you can see that Google and Facebook have the lion's share of the market, but there's 50 billion still available, or was in 2020. Yeah, Digital Turbine only has $1 billion of that so far, and their plan will, of course, be to expand how much of that pie that they are getting. Now, not only that, they're also looking at a pie that is growing quite rapidly through the years. I mentioned before that they had some trouble initially finding their product market fit and scaling, and I think at that point in time they only fulfilled one of these chevrons. I don't know if it was the first or the second of these chevrons, but through the acquisitions, they now have this end-to-end offering. Now here they talk about their most recent acquisitions, but the thing that I wanted to point out that was quite interesting is I love these hockey stick charts. An example of how successful they've been in terms of these acquisitions. So they acquired this company called Appreciate that allows them to do this single tap. They have this single tap product that allows people to install an application from an ad with, you guessed it, a single tap. And recently after the acquisition, they were able to generate $1 million from this within 3 months. A short time later, they were able to generate the same amount of money, $1 million, within 1 month. And less than 6 months later, they were then able to generate $1 million from this capability within 1 week. This just screams to me that the management in this company know exactly what they're doing, and they're in the right place, and they've got a fantastic product. You can also see that they've got lots of top-notch logos, customers that they have won, and they've got an incredibly powerful value proposition, right? So they can say to potential customers, listen, you pay us $1, and for every dollar you give us, you're going to generate an additional $2 to $4. You're going to make double to quadruple your money if you use our platform. I mean, who's not going to buy that? Just looking at the numbers once again. So here we're looking at revenue. Revenue growth has been fantastic. We saw the abbreviated version of that before, but they were still in the year 2021 at this point, and they were estimating revenue of 313 million, up from 138 million the year before. Enormous growth. All right, so let's look at the share price action. So the company share price has been growing. It's been a bit of a wobbly climb from 2017 or so. And then the pandemic struck, a lot of demand was pulled forward. At the same time, those acquisitions really started to work, and the share price of Digital Turbine climbed 900% from the top of the market's pre-pandemic crash in late 2019. And here is where we talk about irrationality for the first time. This share price was absolutely nuts. Any company whose share price grows this amount in this period of time is definitely going to face a strong pullback in the near future. I started looking at Digital Turbine in depth somewhere around the 60s or 70s and felt it was a little too expensive at that point in time. It rose all the way to $90, double topped, and then since November of 2021 has been dropping. In reality, it's been dropping since about February of 2021. So I've been picking up a little bit as the stock has continued to drop, as it reached more reasonable levels. But now the market irrationality has gone in the other direction. Instead of being incredibly overpriced, it has gotten cheaper day by day, week by week, month by month. Okay, so this is a company that I think we can say it's got a strong moat. It's doing very well. It's not a new company. It's generated a lot of revenue. It's generated a lot of profit. Management seems to know what they're doing. So what is a fair price for this company? And it's kind of tricky to say, especially because of those acquisitions, which change the landscape quite a lot. Usually when faced with this kind of challenge, I would value the company in a number of different ways and try to combine those in some way to get what I think is a fair value at the current point in time. I'll do a few of those very quickly for you now. So if we look at the EV over EBITDA for this company, we can see that there was a spike through 2019. This number was negative because of the profitability challenge they were facing before that, and we can see that the levels remained quite elevated through the lockdowns. So there are quite a few events that skew the number, but over this, let's say, 5-year period, we can see that the mean value for the EV over EBITDA is about 54, and the price right now gives us an EV over EBITDA of about 20.6. So this is saying that the company versus its historic self, at least for the last half a decade or so, is cheap, and pretty damn cheap. Now, if we jump over to the competitors, this is quite tricky because there aren't really any companies that have the breadth of offering that Digital Turbine does. But anyway, let's take a look. So Trade Desk is kind of a competitor, although it is a little bit different. But anyway, so if we look at these numbers, we can see that for Digital Turbine, total EV of EBITDA is well below the mean. We can see their PE ratio is well below the mean, and the market cap over their free cash flow is one of the best. Now here we're looking at software companies. If we were to, for example, look at a few of these other categories, we actually see a very similar picture anyway. I'm going to jump out of ticker for a moment just because I like the way that Stockopedia presents some of the data. So we can see immediately that this is a company whose revenue for 3 quarters of the year is about $1 billion. So already 3 times last year's revenue, enormous growth. The market cap is not a very high multiple of that, and this is a software company. So once again, that's starting to feel quite cheap. We can see that recent PEs have been quite high, but future PEs based on forecast earnings are very low. And we'll take a look at a few other companies in a moment just to see how low those really are. I would like to see them expanding margins consistently. They have said that they expect margins to expand through the next few years. That'll be good for free cash flow and profitability. But it needs to be consistent. And this is a company that has no net debt. In fact, they have quite a lot of money on hand. And I would bet anything that they are planning to make a few more acquisitions out of this ecosystem in the coming years. That they're able to turn those into the enormous amount of revenue and profit that they have through the past couple of years. That would be fantastic. Just by the by, a quick back of the napkin kind of calculation you can do is if the PE ratio of a company is the same as the EPS growth, that hints at the company being fair value. So some people will say, oh no, your PE ratio is 80. Let's take, I don't know, Amazon, for example. Your PE ratio is 50. That's way too high. It's higher than anyone else in the industry. But if your EPS growth is also 50%, that means your EPS growth is keeping up with the expectations of the market. And so a better number to look at, usually a better ratio, is this PEG ratio. If this number is less than 1, it means that the EPS growth is outpacing the price to earnings ratio, which means earnings growth is outpacing the multiple that the market is willing to award that particular stock in terms of the PE ratio. All right, so good company, growing company, not a new company, great revenue, fast growing earnings, decent free cash flow, good management, good strategy, good market to be in too. Ad tech is growing nice and fast. Let's look at a few other companies. So Facebook, which has been absolutely hammered because of the capex that some think they might have been misspending, and also the misses that they've had in terms of growth, is trading at PEs that are roughly the same, maybe even slightly more than Digital Turbine, despite Digital Turbine's recent growth and forecast growth being much, much larger than Facebook's. Now, for shits and giggles, let's just take a look at Coca-Cola. Coca-Cola has been doing very, very well recently. The growth has been fairly good for a company that makes sugary water. But you can see price to sales, much, much higher. PE ratios, much, much higher. Growth, much, much lower. What about John Deere? That's a very good company too. They've been doing some fantastically innovative stuff with their self-driving tractors recently. Strong business. PE ratios, slightly higher than Digital Turbine. Growth rates, pretty strong, but much, much lower. Now, of course, I know the counter argument to this is that Coca-Cola and John Deere are established companies that are not dying. The risk is much smaller. etc., etc., etc. But still, this illustrates how irrational the market has been with regards to this particular stock. And in fact, this entire sector, ad tech, has been hammered through the past year. What if we look at the S&P 500? 500 companies across many, many industries sitting at a PE ratio of 20. I don't have the forward-looking earnings growth, but it's definitely much lower than Digital Turbine. All right, and that's about it. This is an abbreviated version of the kind of work that I do day in, day out, looking at the companies I own and the companies that I might want to own, and understanding the market's position overall. Now, do I think Digital Turbine is going to get up to $92 by the end of this year? I think it's pretty unlikely. I don't think they're going to get anywhere near that by the end of this year. But I think that the company is dirt cheap. My various valuation models are saying that the stock price in the medium term should be 150% higher than it is at the moment. And if the company continues to grow like it is right now for years to come, continues to acquire companies and integrate them very well, I think that we could eventually see the share price beyond the $90 range. But I think that would probably take a few years. All right, that's it for this week. I hope that helped. A lot of what I do is based in evidence, and that's what helps me get through these trying times in the market when everything is blood red and has been for a while. All right, have a good week, and I'll speak to you soon. Goodbye.